Every real estate investor has two goals: high cash flow and high appreciation. But the problem is these two don't always come together. There are three main reasons why. First, higher price lowers the current returns. This is where cap rate makes the price and income relationship very clear. Cap rate is simply net operating income (NOI) divided by the property price. In markets with strong demand, limited supply, and land availability, which comes with strong population and job growth expectations, buyers are willing to pay more for the same amount of income. As property price rise faster than the NOI, cap rate compresses. You are paying more for the same amount of income stream, so your current return gets lower. That's the first trade-off. The more investors pay for the future upside, the less current income they receive for every dollar invested. Second, growth often requires reinvestment. A stabilized property can distribute more of its income as cash flow today. But if you are trying to create significant appreciation, you may need to renovate units, improve amenities, upgrade operations, or tolerate the vacancies. That means taking money that could have been distributed today and reinvesting it to create more value tomorrow. You see the same trade off in stocks. Dividend stocks return more cash to investors today. Growth companies reinvest more of its earnings because investors expect the capital to create greater value in the future. Third, different drivers of cash flow versus appreciation. Cash flow depends on what the property generates today: rents, expenses, occupancy, and financing. Appreciation depends more on future growth, population, jobs, zoning, supply, constraints, and neighborhood improvements. But once those growth drivers become obvious, the market starts pricing them in. You are paying more today for the growth you expect tomorrow, and that again compresses the cap rate. High cash flow and high appreciation can exist together, but usually something has to create that extra return. Maybe you bought below the market price, maybe you are repositioning for the asset, or maybe you are taking additional risk. So, which one should you prioritize? That depends on what you're trying to accomplish. If you are retired and living off your portfolio, or if you are investing primarily for passive income, cash flow may matter more. But if you are focused on building long-term net worth, you may be willing to accept less income today for greater appreciation in the future. And one more important point: cap rate is only a snapshot of current property income relative to the price. It doesn't measure your total return over the lifetime of the investment. That's where the metrics like IRR become more useful if you want to consider both cash flow and appreciation together. So don't ask whether cash flow or appreciation is better. Ask which return profile actually fits your goals and your strategy. Follow for more insights on real estate and investing.